In 2020, Robinhood collected $687 million in payment for order flow without charging a single commission. Free trades, zero fees. So where did that money actually come from? It came from you. Not your account balance, something smaller than that. By the end of this video, you'll know exactly what's being sold every single time you tap buy. And it's not what you think. Here's the pitch every trading app makes: commission-free investing for everyone. Tap a button, buy a stock, pay nothing. It sounds like the industry finally did something generous, but commission-free doesn't mean free. It means the fee moved somewhere you can't see it. Before your order ever reaches a stock exchange, it gets sold. Not the stock. The order itself, the information about what you want to buy, how much, and how badly. In 2020, Robinhood's payment for order flow revenue broke down roughly like this. Nearly $400 million from options orders alone, even though options made up a smaller slice of total trades than stocks. Market makers were paying more per order for options than for shares, and that gap is the first clue about where this story is really headed. In December 2020, the SEC fined Robinhood $65 million. That order dealt with conduct from 2015 to 2018, not the 2020 numbers we just covered, but it exposed the same underlying practice. The charge wasn't that payment for order flow is illegal. It isn't. The charge was that Robinhood misled customers about where this revenue came from, and in some cases failed its legal duty to get customers the best available price. In other words, the fine wasn't for selling your order, it was for not telling you. So how does this actually work? When you hit buy, your order doesn't go straight to a stock exchange. It gets routed to a market maker, a private firm that pays your broker for the right to fill your order itself. That firm profits from the tiny gap between what a buyer pays and what a seller receives, plus the payment itself. Multiply that sliver by millions of orders a day, and you've got a business model that never needed you to be right about anything. So who's actually on the other side of your trade? Almost never another retail trader typing into an app like you. It's a handful of enormous firms whose entire business is built around being your counterparty, over and over, millions of times a day, for a razor-thin edge that adds up to billions. That's worth sitting with. The market in your trading app isn't really a crowd of peers. It's a small number of specialized firms on the other side of nearly everything you do. One firm, Citadel Securities, is estimated to execute roughly a quarter to a third of all retail stock trades in the US. Not a quarter of Citadel's trades, a quarter of everyone's. And that's just one firm. Add in the handful of other wholesalers that dominate this business, and the vast majority of retail orders never actually touch a public stock exchange at all. They're filled privately, off exchange, before they get anywhere near one. Think about how a casino actually makes money. It doesn't need to know if you'll win or lose at the table. It needs a small house edge and enough hands played. Market makers work the same way. They don't need to predict where Tesla goes next. They need volume and a fraction of a cent per share, repeated billions of times a year. That's the real reframe here. The opponent in retail trading usually isn't another trader guessing wrong. It's a firm whose business model is completely indifferent to which way the market moves, as long as you keep clicking. Now here's where the fee really concentrates: options. Specifically, the newest and fastest growing corner of the options market, contracts that expire the same day they're bought. They're called zero-date expiration options, or 0DTE, and they've quietly become one of the most heavily traded corners of the entire options market. By 2023, same-day expiration options had grown to roughly half of all trading volume in S&P 500 index options. Contracts that either expire worthless or spike within hours, bought and sold not as an investment, but as something closer to a same-day lottery ticket with a ticker symbol. Here's why that matters to the fee side of the story. Options generally carry a higher payment for order flow rate per contract than stocks pay per share. That's part of why Robinhood's options PFOF revenue beat its equities PFOF revenue in 2020, despite far fewer options trades happening. And the spread on an option, as a percentage of its price, is often way bigger than the spread on the stock underneath it. Academic research on retail options trading, including work from behavioral finance economists like Terence Odian and his collaborators, generally finds that retail options traders lose money on average once you factor in trading costs like the spread. Zero DTE options aren't popular because they're a good strategy. They're popular because they're built to be traded constantly. And constant trading is exactly what generates constant fees. That's the part the lottery ticket framing tends to hide. Now, everything so far is old news if you've ever actually read the fine print on your brokerage app. But there's a newer version of this exact game, one that doesn't even bother hiding the fee anymore. It's just wearing a different costume. Enter prediction markets, platforms like Kalshi and Polymarket, where instead of buying a stock, you buy a contract on whether something will happen. Will the Fed cut rates? Who wins the election? Will it rain in New York on Friday? These platforms exploded during the 2024 U.S. election cycle, with Polymarket's presidential election market alone reportedly processing billions of dollars in contract volume. Kalshi is regulated by the CFTC as an official contract market, not classified as gambling, even though you're placing a bet on a future outcome. And its fee model charges a percentage tied to the price of the contract, meaning the platform earns money on the trade itself, no matter which side ends up being right. Strip away the branding, and here's what's actually happening. A sportsbook takes a cut on a bet. A prediction market takes a fee on a contract. Both are the house collecting a guaranteed slice of a disagreement between two people about the future. The difference is mostly regulatory, not economic. That distinction matters because prediction markets are marketed with the language of investing, positions, markets, liquidity, instead of the language of gambling. And that language makes the exact same rake feel a lot more legitimate than it would if the app just called it what it functionally resembles. So step back and look at all four of these: brokers, market makers, options platforms, prediction markets. They're different products with different branding, but they share one property. Every single one of them makes more money when you trade more often, not when you trade well, more often. That's why the apps are built the way they're built. Robinhood actually removed its confetti animation in 2021 after criticism that it encouraged compulsive trading. But the underlying design didn't really change: push notifications on price swings, instant order confirmations, streaks, leaderboards, one-tap options trading. Researchers and journalists have compared these patterns directly to mobile game and slot machine mechanics. None of that exists to make you a better trader. It exists to make you a more frequent one. That single fact explains almost every design choice in a modern trading app, once you know to look for it. So back to that $687 million. It wasn't a gift, and it wasn't some mystery fee hidden in your statement. It was your order, sold in real time, to firms whose entire business is built on trading against people who don't know they're being traded against. Every free trade, every zero DTE option, every prediction market contract, somebody on the other side already calculated their edge before you ever clicked buy. The house doesn't need to guess which way the market moves. It just needs you to keep playing. So before your next trade, don't just ask, "What's my edge?" Ask, "Who's on the other side of this, and how do they get paid?" Because on most retail platforms, that second answer is a lot more predictable than the market itself. This video explains market structure and business models for educational purposes, not investment advice. Understanding fee incentives is a research skill, not a signal to trade more or less, and it isn't a recommendation for your specific situation. If this changed how you think about money, subscribe. There's a new breakdown every week.